All right, it's time for me to bring in Kumar, the CEO of Value Research. Thank you so much for joining us. It's always a pleasure to have you on Investor's Guide.
Thank you.
Let's get straight to our portfolio question. Well, Dr. PREETAM has written in, he's 32 years old. He's a dentist. He tells us his wife is also a dentist and they run a private practice together. He has a health cover of about 3 lakh rupees. And he has 3 insurance policies from LIC. That causes me a fair amount of concern. He also has 9 lakh rupees right now in fixed deposits. Now, the couple don't have any children at this point, but they are planning on starting a family. And he wants to know how he can put together a corpus of about 40 to 50 lakh rupees over the next 10 years. If investing 15,000 rupees every month will get him to that amount. And if we do a quick back of the envelope calculation, even if he makes 12% a year, at 15,000 rupees a month, he'll have about 34 lakh rupees. And he also told us later when we got in touch with him that he hopes to have about 1 crore rupees set aside for his child when the child is ready to go to college. And that we know, since they don't have children right now, is going to be in at least another 20 years at least. So let's take them one by one, Dhirendra. His first question is, should I continue my LIC policies? He has 3 policies, 2 on his name, 1 on his wife's name. Would you like him to continue all 3 of them?
Yeah, he should discontinue the 3, and the reason is very simple, and he should not only discontinue, he should plan withdrawal, and not only that, it's very important for him to substitute it with a sizable term insurance because both are working, they're working couple. So both of them should, right now one can assume that they are financially dependent on each other as their practices planned together. So both deserve, or justify getting a term cover, and they should just look at their, though the dependence may not be very high, but still it is important to take that term cover. That is what we take life insurance cover for.
All right, so that's the advice you're getting. We would like you to methodically move out of those insurance policies. Dhirendra, the next thing we need to look at is that since both of them are self-employed, obviously they're working towards creating something of their own, but in the meantime, they have no pension and they have no health insurance. So let's look at it point by point. You normally tell us to have an emergency fund. They have 9 lakh rupees in a fixed deposit. That could function as an emergency fund. But in terms of creating their own pension plan for the 2 of them, he's considering putting 5,000 rupees every month in a PPF, which will, over the next 10 years, grow to about 10 lakh rupees. Is that the best way to go? Would you like each of them to start a PPF account to compensate for the fact that they have no compulsory PF?
No, I would strongly discourage them to do that because, PPF, of course, you get guaranteed return. Of course, the income from that your PPF contribution, that income that you derive is tax-free. But given that, you're saving for next 25, 30 years, it doesn't make sense. A PPF will give you a guaranteed 8.5%. That is not good enough. It is not good enough to beat inflation. All you derive from PPF is the safety. So I would urge both of them that they should invest, they should choose one tax saving fund, invest regularly, invest 12,500 rupees, you will get a tax break. The return on this accumulation will be entirely tax free. And in 20 years time, I'm confident that, your accumulation, I was doing an illustration last week and somebody who would have, assuming that somebody would have, invested 12,500 rupees every month in PPF, in 20 years time frame, it will accumulate to about 85 lakh rupees, which is good, which is a handsome accumulation. But assuming that you were doing this, making this contribution or saving this, accumulating your savings in a Sensex fund, that will also accumulate to about 1.4 crore, which is also interesting and a sizable money. So I would say the rewards of active management, or rewards of investing in equity, the rewards of equity, investing in equity regularly, and that too, investing regularly in an actively managed fund over such a long period is phenomenal. So all you need is discipline. Don't get distracted. And PPF, it's a traditional investment. It is safe, but you derive all the safety by investing in equity in a methodical way for such long period.
All right, so we would like you to look at equity instead. And of course, on this show, we always recommend you go through mutual funds and not directly to the stock market. Dhirendra, if he's putting aside 15,000 rupees, which according to my calculation will not be enough to hit his target in the next 10 years, so we would like him to increase his allocation, what funds would you like him to use to make that long-term secure investment to equity that you just talked about?
Most people actually, when they look at safety or when they look at security of their investment, they basically look at that it should not go down in value even in the short run. And that is not always possible. When you are investing for the long run and when you are investing regularly, you are able to eliminate a good part of the risk. I think if you just choose the 3-4 funds which we keep recommending on our tax, among our tax saving bets, they're worthwhile. That apart, review it. Investing for the long run doesn't mean that you choose a fund and stay invested. Review it every 2-3 years and make changes every 2-3 years, not every other every now and then when your money is out of the lock-in period.
All right, so use TAXSAVERS, and of course on your screen right now are TAXSAVERS that we have recommended. If you want more help on picking your funds, write to us. Email ID is on your screen as well. A quick recap: you have to have a term insurance cover both for you and your wife, especially if you're going to consider starting a family. Dhirendra there is saying methodically move out of the insurance policies that you already have. Make sure that you're using equity for the long term for everything, whether it's planning for your children or your own retirements. Use equity funds to invest for the long term. The longer you hold these funds, the longer they will compound and you will get better returns. Let's take another question, moving on to our hold or sell segment. Avik has written in, Dhirendra, he wants to invest for the future of his 3-month-old daughter. Congratulations, Avik. He tells us his financial advisors designed a portfolio for him, but he wants to know, and he's chosen his words very carefully, he wants to know if this portfolio, according to you, is perfect. So he sent us a list of the funds in his portfolio. He wants to know whether he should continue these investments. SBI Magnum Multiplier Plus 93 is the first on his list. For someone with a very, very long-term horizon, would you recommend he continue this investment?
Yes, it's a good fund and it has become all the more interesting. It has become impressive of late as well. So he should continue.
The next fund on his list is also very impressive, Dhirendra. This is the Axis Long-Term Equity Fund. I know you've personally been very impressed with its performance. Should he continue with this investment as well?
Yes, very much so. In fact, this is a fund which certainly has been very impressive. It lacks the long track record, but whatever history it has come out of nowhere to be, and he should continue. It's a tax-saving fund. The money which he's investing here gets logged in, but doesn't matter. All your equity investment should be, you should have a view of 3 years, definitely 3 years and more, so that lock-in should not bother you.
So Avik, if you didn't already realize it, this particular fund you can use to claim your ATC tax deduction at the end of the year. So if you're making that investment, that's an added advantage that you have. The next on his list is the BNP Paribas Mid-Cap Fund, Dhirendra. Continue investing in this one. Is this the best mid-cap among all of the options he has in the market right now?
Yes, mid-cap funds are, this is a good mid-cap fund. It has evolved very nicely over the last 2-3 years. And anyway, when choosing a mid-cap or a small cap or a micro-cap fund, I don't think, it's a kind of fund where you give a very loose mandate that, okay, manage my money and I will withstand all kind of intermittent underperformance as well. When we choose a diversified equity fund, I think, one takes such view. But in a mid-cap fund or a small, or, a fund with a narrow objective, one has to keep track of it a little more closely. But as of now, it is among, I will consider it among the few good mid-cap funds.
Well, the Kotak Select Focus is also on his list, Dhirendra. This is interesting. It's not a very large fund. It has about 500 crore rupees assets under management. We don't hear about it too often. But it is a great performer, especially in this last 1 year during the recovery. Would you recommend he continue this fund as well?
Yes, this is also a very impressive fund. It was a very disappointing fund, 2-3 years back. And after that, there was a change of fund manager. I think he's doing his work. He has done the job. And there has been, tweaking in the portfolio, not a radical one, but yes, it seems to be performing. And, the fund has got back its selectivity. And that shows in its performance. So it's proving to be an attractive fund today.
Next on his list is another very interesting selection, the Tata Ethical Fund, Dhirendra. This is a Sharia fund, but does it make sense for any investor to use?
I look at it as a fund which does not invest in bank when compared to other diversified equity fund, and otherwise it remains a largely well-diversified fund. So it's not a huge compromise on diversification, but I do, if you are not looking at a Sharia compliant fund, or there is no special reason why you should not be actually investing in the other funds which are more diverse.
Well, the last on his list is the Birla Sun Life Frontline Equity, another great performer, Dhirendra. And it does seem like this particular financial advisor has done his research and he's put together a very interesting portfolio. A, would you like him to continue this investment? And when you look at his whole portfolio in one look, would you say it's well thought out and well designed?
You know, looking at it holistically, it is a very well diversified fund. And for a long term, also having that mid-cap fund and access to long-term equity, which I would say is a mid-cap fund. But he will have to, he will have to review 2 or 3 of his positions. This is not a portfolio which he can be very passive about. He will have to look at those 3 funds every 2-3 years and review it.
All right, so it does seem like a really well put together portfolio. And of course, if you have any more questions for Dhirendra, you can write to us. Our email ID is at the bottom of your screen. Avik, that portfolio is perfect. So congratulations on the baby daughter and congratulations on finding a good financial advisor. In my book, that's reason to celebrate. Let's move on to a few more questions. Srinivas Kalyan has written in, Dhirendra. He says he works for a private construction firm and takes home a monthly income of 55,000 rupees, out of which he saves about 35,000 rupees every month. He wants to know where he should invest this money. Now, this is the interesting part. The next few questions we have on the show are from complete novices who have just begun investing. He tells us also that he may move to the Gulf in the next few months where his income will go up. So he wants us to budget the increased income as well when we give him a plan. So for someone who's just starting off, obviously we'd like him to have an emergency fund, we'd like him to have health insurance and life insurance. But if you were to pick funds right now in this market, what would you like him to do?
I would like him to, follow our aggressive portfolio. And before that, of course, he should take care of his term, life insurance need and health insurance. But after that, I think, he should just go follow our aggressive portfolio, spread his, investments in exactly the same proportion.
All right, our aggressive portfolio is on your screen right now. If you have any questions about this portfolio, you'd like us to send you a list, write to us. Email ID is also on your screen. One more question, Dhirendra, and the reason why I picked this question this week is because we're getting so many of these, given where the market is and how it's moving. Praveen Kumar has written in, he just got a raise of 5,000 rupees a month. Congratulations, Praveen, we're very proud of you. He wants to know how he should use this money. He has a home loan right now, so he's saying the extra 5,000 that I have, should I use it to pay off my home loan, which means increase his EMI, maybe bring down the tenure, or should he be investing it in mutual funds towards SIPs? What funds should he be investing his savings in? So the fundamental question he's asking, Dhirendra, is this. Over the next 5 years, do you expect equity to beat the home loan rate, which is currently between 10 or 10.5%, depending on which bank you're from?
Yes, very likely. And but 5 years is not long enough period. But going by what the home loan rates are, or the interest expense he will be incurring, I'm very confident that equity returns will definitely beat that. But when it comes to a long time frame, investing for 20 years and incurring home loan interest for 20 years, add to that, the tax break that you get, the capital appreciation that you derive on your home, and that apart, if you are able to save on the rental outflow as well. So all these 3 combined together, I think it makes eminent sense to not prepay your home loan, and or maybe even if you have a sizable contribution accumulation, maybe it is worthwhile to take that view, because equity returns are likely to deliver more return than the interest that you will incur on your home loan.
But Dhirendra, I have a counter question for you from some of our other viewers. Of course, a lot of us have compulsory PF deductions, and one of the options within the PF rules is that if you're buying a home or you're investing in a home, that you can withdraw a portion of your PF. Now, given the fact that the PF compounds at 8.7% right now, that's the rate, and the home loan is at 10%, does that make sense then to pull out the PF and use it towards the home loan?
Yes, by all means, because effectively it amounts to a situation where your own saving is earning less than the amount that you have borrowed. So from that standpoint, definitely.
So that's interesting. If you have a home loan, then and you're trying to choose between the home loan and equity, Dhirendra, they're saying if you give it a 10 or a 20-year horizon, equity will definitely beat your home loan return. If you have PF and a home loan, then as long as it's not the only investment you're making, it does make sense to withdraw a portion of your PF and use it to bring down your loan amount. Let's move on now to our product review of the week. This week, we're looking at the HDFC TAXSAVER Fund. It's one of the most popular tax savers in our market right now. Avan will give us a quick introduction and then we'll come back and talk about it. Avan.
Thanks, Faye. Under the scanner this week is the HDFC TAXSAVER Fund. The fund is known for its consistent performance irrespective of the direction the market takes. In its 18-year track record, the fund has underperformed its category very few times. The fund manager uses a multi-cap approach, investing roughly 60% in large caps and the remaining 40% in small and mid caps. His investments typically span a 2 to 3 year time horizon, which is why you should not be too disappointed if this fund underperforms in the short term. Look at the performance over the long term. The fund has given a return of 22% annualized over 10 years, 24% over 15 years, and 30% since its launch. So if you're a conservative investor looking to protect your capital, this fund should suit your needs as it takes very calculative risks and gives average returns. So is this the fund that we should use to save our tax this year? Our experts are here to give you the answer. With that, it's back to you, Faye.
All right, Avan, thank you for those details. Dhirendra, HDFC TAXSAVER has been a strong tax saver with a great track record, although it did, like all the other HDFC equity funds, take quite a beating during the bad market last year. And interestingly, the last time we talked about it, you gave it 4 stars. It has dropped 1 star on value research since then. It's a 3-star fund. What would you like to do? Would you like to, re-rate it now that it has come up with the rest of the pack from HDFC?
No, not really. The character of this fund has changed a bit. In fact, its early phases, it was a mid-cap fund and it made a name for itself. 2012, this fund really struggled. It struggled to beat its own benchmark. In fact, it delivered 5% lower return than its own benchmark. But of course, its long-term numbers remains intact. It has delivered good returns. And I would say that by no, yardstick, I would say that it's a bad fund. Yes, there are superior alternatives. The tax-saving fund universe has now more promising funds. And this fund, the way this is configured, it is a large cap fund. The fund should be assuming greater risk and, where it has made a name for itself. I think, that emphasis seems lacking in this portfolio. So I'm not expecting what, the kind of character it demonstrated in, the mid 2005-06, which were the golden years for this fund. So I would say it's a good fund, but it's not the most promising fund in this category.
All right, so there you have it. That's the HDFC TAXSAVER Fund. Dhirendra, would you like to give it a star rating right now?
Yes, I would give it a 3-star.
3 stars, which means that from the last time we reviewed this fund, it's actually lost 1 more star. 3 stars for HDFC TAXSAVER on Investor's Guide. And that brings us to the end of this segment. Dhirendra, thank you so much for spending time with us on the show. It's always a pleasure to chat with you.
Thank you.
And I know the viewers look forward to your advice. So if you have a question for Dhirendra Kumar, write to us. Our email ID is at the bottom of your screen. Welcome back. You're watching Investor's Guide on ET Now. Thank you for staying with us. I've asked Vishal Kapoor to join us this week and answer more questions that you sent in on asset allocation. Vishal is our asset allocation expert. Vishal, our first question comes in from Deepak John, who writes in from Kuwait. He tells us he has savings of 4 lakh rupees and he wants to know if he should invest this money in gold because the price of gold has come down. Is ETF a good idea? He can also, apart from this, save 1 lakh rupees every month. With a time horizon of 6 to 7 years, where should he invest that money? So Vishal, obviously, if he has a slightly long-term horizon, we'd like him to invest in equity. But if he's hell-bent on the idea of putting some money in gold, would ETF be the best way to do that?
For Deepak, for his investment into gold, I think a gold ETF does make sense, but he would need to open a demat account for that purpose, and then it would be very easy for him to transact. If a demat account is a challenge, then a gold fund may be another way to look at investing into gold. Now, for his other objective of investing into equity funds, I think the aggressive or the growth portfolio is one good way to get started. Alternatively, he could look at a mix of funds like the ICICI Pru Dynamic, the BSL Frontline Equity, or even the iPru Top 100 as a combination to get started into India-focused onshore diversified equity funds.
Our next question comes in from Siddharth Verma, who's already investing in the DSP BlackRock Small and Mid Cap Fund and the DSP BlackRock Top 100 Equity. He says he can add another 4,000 rupees every month with a time horizon of 5 years. Where should he invest that money? Vishal, obviously we'd like Siddharth to have a longer time horizon if he can afford to, but what advice would you give him?
For Siddharth, firstly, I would say it's good to see him started in an SIP and with a combination of both a large cap oriented fund as well as a small and mid cap fund. So can't fault that. I think it's a good combination overall. The only nuance he could consider is that both these funds are with the same fund manager. So if there's another level of refinement or a different style that he wants to add rather than just be with the same fund house, since it may not cost any significant amount, he could consider one of the funds being with another manager. So it just gives him an added level of diversification in styles from a fund house standpoint. He could choose either of the two. So for example, he could keep the small and mid cap with the DSP BlackRock team, and for the large cap he could look at an alternate fund like, let's say, the ICICI Pro Top 100 or the UTI Opportunities or any other good performing large cap fund to provide a combination which also has a bit of a diversity in terms of fund management style.
Kaushik has also written in, he has about 35 lakh rupees in fixed deposits. He now wants to move this money to an ICICI Prudential mutual fund. He wants to know what he should do. So Vishal, he's left a couple of grey areas here. He hasn't told us how old he is. He hasn't told us what asset class he wants. So is he looking at an equity fund or a debt fund? We don't really know. But for someone who's moving such a lot of money from fixed deposits, I'm assuming he's not going to want to go all out equity and take on that much risk. What advice would you give him?
The way we are looking at your objective is that you want security, even though you want to invest for 5 years, and you're really looking at an alternative to your fixed deposit and an alternative that doesn't deduct TDS when you get your returns. A fund may be a good way to do that. If an ICICI Prudential is an alternative or a preference for you, then the ICICI Prudential Flexible Income Plan may be one alternative for you. But I would recommend that instead of putting all your eggs or all your money into just one fund, maybe you can diversify it into a few more fixed income funds. The HDFC Income Fund or the JP Morgan Income Fund may be another alternative that you could look at.
All right, last question on the show. Manjunath has written in, where should he invest via SIPs for the long term? He's been investing in the SBI Gold Fund and Reliance Gold Savings for the last 2 years. Should he hold on to these investments? Obviously, I mean, gold is down about 18% over the last year, Vishal, so which means that he's going to be disappointed with both of those investments. I'd like him to look at perhaps equity for the future. What would you like him to do?
For Manjunath, I would think that the gold fund is really not the best way to get started and keep that investment. So that is an investment I would say is probably worth getting out of, provided of course he doesn't have a major tax liability. Otherwise he could hold on for one more year, complete 3 years and then get out if taxation is something that bothers him. For his age, provided that he can take the risk, I would think that he should go with the growth portfolio, or he should go with a few diversified funds. The L&T equity, for example, or the ICICI Pro Top 100, the UTI Opportunities, for example. Those are funds which are diversified and may offer a good combination of styles to make a portfolio which is growth oriented. So that's what he should really be in right now.
All right, that's a wrap on this show. Vishal, thank you so much for answering all of our questions this week. Remember, if you have a question for either Dhirendra or Vishal or myself, write to us. Email ID is at the bottom of your screen. You can also reach me personally on Twitter. Give me some feedback. I'd love to hear from you. Thanks so much for watching.